Greetings, Culture Warriors. It is I, Jeff Vieira, the author of Culture is Everything, and your host for this latest dispatch from the front. Back to the news for you today. I want to take a look at a story here that's from Microsoft News and Reader's Digest. This is the bank with the worst reputation in America. Jana Taylor Smith is the author of this article. Managing your finances can be stressful, but typically you trust that your bank can help you do things like setting up the right savings account and providing good customer service when you have questions about your account. That is, of course, if you have a good bank. However, to be a good bank for their customers, banks need to have other assets, including a good reputation. And unfortunately for one bank, it's ranked at the bottom of a list of the 100 most reputable companies in the country. Wells Fargo and Company was ranked as the bank with the worst reputation in America, according to the 2020 and 2019 Harris Poll Reputation Quotient rankings. For the second year in a row, the company ranks at number 96 and has a reputation quotient of 61.2 out of a maximum score of 100. Here's how to choose the right bank for your needs, according to a money expert. The poll asked study participants to list companies they believed had good or bad reputations. These companies were then ranked based on 6 dimensions of corporate reputation. These dimensions include social responsibility, products and services, emotional appeal, workplace environment, financial performance, and vision and leadership. The RQ ratings are then developed into a formula. A score of 80 and above is excellent, 70 to 74 is good, 55 to 64 is poor, below 50 is critical. Another bank with a dismal reputation ranking is Bank of America. It ranked at number 92 and had a poor score of 60.9. If a company is not ranked, that does not necessarily suggest that they have either a good or bad reputation, but rather they didn't reach a critical level of visibility to be measured, says the Harris Poll website. All right, so this story is unfortunately largely garbage, and here's why. So if you're going to do a story based on the reputation quotient rankings, the maximum score is 100, and higher is better, then how is it the Wells Fargo comes out on the bottom with a score of 61.2 and Bank of America has a score of 60.9, and yet Wells Fargo is on the bottom? That makes absolutely no sense. Now, the fact of the matter is the Wells Fargo has been in the news for some negative things lately. They've had a rough go of it. I happen to know several professionals at Wells Fargo who are working hard to turn that around for the company, but they've had their challenges. They've had leadership changes. They're going through some culture changes right now, and they certainly have some work to do. No doubt about it. Their brand has been damaged in the marketplace. But Bank of America, which I formerly worked at, I was at Bank of America for about 10 years. Bank of America, following the financial crisis, had a really poor reputation and has rebuilt it. Brian Moynihan, the CEO of Bank of America, is one of the more admired CEOs out there. And yet their reputation score is worse than Wells Fargo. So the article doesn't make a whole heck of a lot of sense. I had to edit a couple of times in reading the article because they put in clickbait nonsense right in the body of the paragraphs. So this person who wrote it, Jana Taylor Smith, not a very good writer, doesn't seem to understand the financial beat either. Here's another problem with this kind of approach. When you say reputation, and then you point to this as being the essential element in determining if you have a good bank, right? Then what might you expect reputation to consist of? Social responsibility. Well, that's a nice left-wing PC term, but that's not what I think of when I think of a bank. I think of a bank that has money, nice safe assets, that helps people to make good financial decisions for their future, has a great array of products, so you can do business with them over the long haul. Despite the fact that I left Bank of America in 2014, so that's about 6 years ago now, I have an ongoing relationship with Bank of America. I use Bank of America for quite a lot. In fact, my retirement is with Bank of America through Merrill Lynch. So I've maintained a relationship with the company long after I've left it because I like what they have to offer me. Now, Bank of America, like a lot of big companies, has bought their improved reputation in the media by virtue signaling in the areas that the media cares about. Not their customers, the media. So I don't agree with Moynihan's forays into social responsibility any more than I agreed with it when Jeff Immelt at General Electric did the same thing, although he did it to the exclusion of running his own business. And General Electric cratered in response. So General Electric, company very fondly thought of by the Obama administration, and has been flat on its back ever since. Don't like it. Don't think it's valid criteria. Products and services. Okay, well, that's more like it. Yeah, a good bank will offer you a wide array of products and services that are useful to you. Emotional appeal. Who the heck thinks of banks in emotional terms? I worked there for 10 years, and I don't think of Bank of America in emotional terms. Now, I know that when they do their advertising, they try and tug at the heartstrings. I get that. But the bottom line of it is banking is one of the least emotionally appealing aspects of anyone's life. And I was a banker. Workplace environment has nothing to do with anything. Does anybody really care about how the workplace environment is if you're not working at the company? You know, I think there are rare situations where we do. I've harped in on Amazon in the relentless stories about how they treat their warehouse workers. I suppose you could argue that that would fall under the category of workplace environment and would have an impact on reputation in that case. But these are banks. How hard can it be, right? Financial performance. Well, obviously that's real important. Whether you're a shareholder of the bank or you just want to make sure your money's safe, financial performance matters. Vision and leadership. It starts getting a little abstracty. You know, when you say vision and leadership, what do you mean? Jamie Dimon over at the J.P. Morgan is one of the most politically active CEOs out there in the banking industry. I could do with a little less vision and leadership, frankly, from J.P. Morgan Chase. When you look at other banks in the industry, Citigroup has been a parking spot for Democrat politicians out of office for years and years and years, ever since Bob Rubin went over there. So vision and leadership, I guess I could use a little more focus on banking, a little bit less on politics. Might be good for them. In terms of vision and leadership, the only situation I can think of where I viewed that as a positive aspect to reputation was when John Allison was running BB&T. They were famously one of the banks that didn't get involved with the derivative swaps and everything that characterized the last financial crisis. Allison had a principled stand against it, chose not to go for the easy money while the mortgage bubble was being inflated. And as a consequence, his bank was in much better shape when the others were going down in the financial crisis. That, to me, is vision and leadership. But it's got to pertain to what you're trying to do within the financial industry. And I'm not really sure that people, as consumers, when they think about their bank, really care about that. So I guess net, the 6 dimensions of corporate reputation being applied here, I just don't think that it's got enough customer flavor to it. Things that the customer really cares about. And it's the customer who is going to determine what your reputation is and how it plays out in the marketplace. So while I was drawn to the article because reputation does matter and it's a reflection of culture, this is an example of a clickbait kind of article where there's not a lot of rigor behind it. It's misinterpreted. And it doesn't tell you a lot. In talking about the relative situation with Wells Fargo and Bank of America, and in Charlotte, North Carolina, they exist right across the street from one another. So there's a lot of turnover between the banks that results in executives and employees kind of crossing the street and going to work for the other bank. But I can tell you that the people that are over and working on Wells Fargo's cultural issues are some pretty strong people. They were the ones who for the most part, turned Bank of America around in the wake of the financial crisis, and now they've been gravitating towards Wells to help them do the same thing. So I think you're going to see, regardless of this bogus reputation index garbage in this article, I think what you're going to see is that in reality, Wells's image is going to improve significantly over the next couple of years, thanks to the hard work that these people are doing to make it a better, stronger company. And all you can do in those situations where you have a couple of those big whoopses is really roll up your sleeves and make it better. When I was at Bank of America and the financial crisis was in the middle of my 10-year tenure there, we ran into an issue where we had purchased Countrywide Mortgage, that was the number one mortgage originator in the country at the time. We had kept trying to become number one. We couldn't. And so when the opportunity came to buy Countrywide, we did. We leapt at it. And because we assumed that since they were number one, they knew what they were doing, we junked a bunch of our own mortgage business process controls that we had in place, particularly around verification of income in the underwriting process. That's where you go in and make sure that people can afford to buy the house that they're trying to buy. So we threw all that away, and then come to find out the Countrywide didn't really have any controls on that stuff. They were the number one mortgage originator because they would just go out and take anybody. And so this led to an interesting series of events, because at the same time the Bank of America was figuring this out and realizing that we had some real stinker loans somewhere in the portfolio. The other problem that we had was because Countrywide didn't do its due diligence, we couldn't identify which of these loans were likely to default. The information wasn't taken. The due diligence wasn't done. So what do you do now? Now you got a loan that's paying right now, but you don't know if it will in the future. You don't have a way to see that. And so, at the same time, Fannie Mae and Freddie Mac, which are the government agencies that specialize in mortgage origination for lower income homebuyers, they started to get their nose bent out of joint because they were missing out on bonuses because companies like Countrywide were stealing the lower end of the market from them, in their opinion. And so they started saying, hey, we want those loans. And so, what would you do? You have an unknown level of risk. You have the government, they're government agencies. They're also your partners in some ways. They're also your regulators in others. So what do you do? Well, we said, okay, here you go. And they took a bunch of those loans. Every bank did that. Got them off the books that way. For the ones that we retained, they had to figure out a way to mitigate the risk. So what they did was they created derivative products from it, which basically says, look, we expect that people are going to continue to pay their mortgage. They historically always have. But we do have a higher level of risk of default on these in this package. So you bundle them together and you sell the package of them. And you realize that, hey, historically, 95% of that package should be okay. So what happened? Well, what happened was the default rate went up significantly when the housing bubble burst. And when we say the housing bubble burst, what happened was suddenly housing values dropped precipitously. And so now you may have spent $500,000 on your home. It may have represented a significant portion of your take-home pay. So it was difficult to maintain the mortgage on that. And then all of a sudden, the house that you just paid $500,000 for is going to take in maybe $400,000 if you turned around and sold it. So you're looking at, on the face of it, losing $100,000. Well, when people realize that their house is underwater, that's what it means, then their motivation to continue paying the mortgage goes down. And so the default rate, when they start missing payments and the like, goes up. And so what we started to see was a real creeping up of the default rate. It got up to somewhere between 10 and 20% over the short term there. And so now what we thought was about, historically a 5% or under kind of default rate was really starting to become scary. And you had unprecedented situations where people would just abandon the house. Throw us the keys. We need to figure it out. We realized that some of that was due also to the fact that as an incentive to get people into a house, they would offer lower mortgage rates as an introductory offer, and then tie it to the overall interest rates through an adjustable rate mortgage, which is great on the face of it until interest rates start to tick up. And even a slight uptick in interest rates can really have an outsized impact on what you pay and how much equity you have. So people in these arms started to get skittish, and they needed to have a loan modification in order to get out of the adjustable rate mortgage and get into a fixed rate. But of course, if the interest rate's even a little bit higher when you do that, you're going to lose some money on that transaction. So we had a lot of that going on, and that started to tax the resources of the banks to process all that. So then the wider financial system starts to have a credit crunch, and things get bad even faster. So I and a bunch of other doughty souls were asked to go over into our mortgage business and figure out how to fix all that mess. The regulators were mad at us, accusing us of all sorts of nefarious things. And we had a $2 billion business that suddenly we couldn't make any money on. We couldn't collect the fees because we were also finding that with the Countrywide loans, it was questionable as to whether we actually owned the paper on that loan or not, given their accounting. So, massive undertaking. I'll never forget. We had 22,809 rules that were emerging in the early days of this financial crisis from the various regulators, and everyone seemed to be in a rush to define another rule for the banks to comply with. And so I had to sort through those 22,809, find the ones that were directly related to our fees, and figure out what the controls needed to be and help deploy those controls so that we could test them, show that we were complying with whatever the language was that was the latest from the lawyers and the regulators, and pass some of those regulatory exams so that we could prove that we were entitled to those fees and get the spigot turned back on for the business. This was a very intense engagement, a lot of people working on it, and we basically had 90 days to fix the business. So a lot of those people that were over there in the mortgage business with me working on this very difficult problem are the same people who are now at Wells Fargo working on their issues. They were very successful, in the case of Bank of America and the mortgage business in particular, in turning things around and turning them around quickly. And I can tell you from personal experience that it takes a lot of dedication in order to do a job like that. I used to get phone calls at 9 p.m. at night after a long day of doing this stuff from people whose homes were about to be foreclosed on in the morning. And they were trying to find someone at the bank to talk to about it. And so I would take the time and try and figure out anyone I could over in that business that I could give them a warm handoff to who could help them get with the right banker to solve their problem. And everyone on that team had similar experiences because we could all certainly empathize with people who were in danger of losing their homes. So when you think about what's going on with the reputation of a bank, I would say in general that if you have a bank where people care enough about the customer to do those sorts of things, you've got a good bank. Reputation quotient there be damned. You've got a good bank. I think the quality of the talent that's over there right now at Wells Fargo working to dig out of the hole their brand has gotten itself into is such that you're going to find that very soon you'll be able to say, as a Wells Fargo customer, I've got a very good bank here. Because at the end of the day, problems come and go, clickbait media stories come and go, but culture is everything. Thank you and have a terrific day.